When we look at a company's finances, there are three big, important reports. But one of them, well, it gets overlooked all the time. And that's a huge mistake because it's the only one that gives you the stone cold truth about a business's health. It cuts through all the accounting jargon and gets straight to what's real. We're talking about the statement of cash flows. And believe me, it is the ultimate financial reality check.
Okay, if you remember just one thing from this entire explainer, make it this. This is our mantra. Profit is an opinion, but cash is a fact. Seriously, this one idea is the key that unlocks everything. Why? Because profit, well, it's a bit subjective. It can be massaged. But cash? Cash is real. It's either in the bank or it isn't. Simple as that.
And that simple fact brings us to this big, juicy mystery. How on earth can a company splash headlines with record profits, and then a few months later, they're suddenly struggling to even pay their employees? It just doesn't make any sense, right? How can you be wildly profitable and totally broke at the same time? Well, it's not magic. There's a very real answer. And the answer, drumroll please, is the statement of cash flows. This is the document that solves the puzzle. It completely ignores all those fuzzy accounting estimates, things like depreciation or when a sale technically happens on paper. Instead, it asks one simple question. What actually happened with the cash? It's the financial ground truth. All right, so here's how we're going to crack this case today. First up is the reality check, why profit isn't cash. Then we'll break down the three pillars of the statement. We'll look at the two methods used to build it, discover why it's such an indispensable tool, and finish up with how it works as the ultimate bridge. Let's dive in. So let's get right into it. Think of it this way. The income statement tells you if a company is making money in theory. It's the story of its potential. But the cash flow statement, it tells you if the company is solvent. In other words, can it actually pay its bills right now? Can it keep the lights on this month? One is the movie script, the other is the behind-the-scenes documentary of what really happened. To really get this, we've got to pop the hood and see how this thing is built. It's not just a random jumble of numbers. It's beautifully organized into three main sections. You can think of them as the three pillars that hold up the whole story of a company's cash. And those three pillars are operating activities, investing activities, and financing activities. In plain English, that's how the business makes money day to day, how it's planning for the future, and where its funding comes from. Together, they paint the complete picture. First up is operating activities. Now, if you only look at one section, make it this one. This is the absolute engine room of the business. It's the cash that comes from, actually selling their stuff or providing their service. If you see a nice, consistently positive number here, that is a huge green flag. It means the core business is healthy. Next up, we have investing activities. This part is all about the future. It shows you if the company is spending money to grow. Are they buying new machinery, building new factories? And here's a little twist for you. A negative number here is often a good thing. Yeah, you heard me right. It means they're pouring cash back into the business to fuel future growth. It's a sign of confidence. And our third and final pillar is financing activities. This one's pretty straightforward. It's all about how the company is funded. It tracks the cash moving between the company and its owners or its lenders. So are they taking out new loans, selling more shares of stock, or maybe paying back their investors with dividends? All of that is right here. Okay, let's peek under the hood a little deeper. When it comes to that super important operating section, accounting rules, specifically IFRS or IAS 7 for the purists, give companies two ways to do the math. They're called the direct and indirect methods. Now, they both get you to the exact same final number, but the journey is totally different. So you've got the direct method, which is exactly what it sounds like. It literally lists cash in from customers, cash out to suppliers. It's super clear, but it's a ton of work, so you almost never see it. Then you have the indirect method, and this is the one you'll see 99% of the time. Why? Because it does something kind of magical. It connects the opinion of profit directly to the fact of cash. So how does this indirect method work its magic? Well, it's basically a reconciliation. You start with net profit from the income statement. Then you start adjusting. First, you add back any expenses that weren't actually cash, like depreciation. Then, and this is key, you adjust for changes in what's called working capital. That's all the cash tied up in things like inventory or what your customers still owe you. Do those steps, and poof, you've turned profit into real cash. Okay, so we've seen how the sausage is made. Now, for the really good part. Why should you care? What's the big payoff? Well, it's because understanding this statement lets us finally solve that puzzle we started with, the mystery of a company's true health. The number one reason, solvency. I mean, who cares how much profit you have if you can't make payroll on Friday? The statement of cash flows cuts right to the chase. It tells you, bluntly, if a company has the cold, hard cash to survive. It's the ultimate stress test. Reason number two is something analysts call earnings quality. And this gets right to the heart of our mystery. If you see a company with massive profits, but barely any cash coming in from its main operations, Houston, we have a problem. That's a huge red flag. It might mean they're making a ton of sales on paper, but they're just not collecting the cash. And this chart just says it all, doesn't it? Look at that giant bar for reported profit, and then look at the teeny tiny little bar for the actual cash they brought in. When you see a gap like that, your alarm bells should be ringing. That's the kind of thing only the cash flow statement will show you. And there's one last really elegant thing this statement does. It acts as a perfect bridge. It explains down to the last dollar how a company's cash balance went from point A at the start of the year to point B at the end. Let me show you what I mean. So let's say our company starts the year with $5 million in the bank. That number comes right off of last year's balance sheet. Got it? That's our starting line. Okay, now throughout the year, cash is flying around, right? It's coming in from operations, going out for investments, coming in from financing. All that activity from our three pillars gets added up. That gives us the total net change in cash for the entire year. And then you just take that net change and you add it to the $5 million we started with. And what do you get? In our example, $8 million. And here's the beautiful part. That $8 million will match the cash number on this year's balance sheet perfectly, every single time. It's a flawless reconciliation. Which brings us full circle, right back to our mantra. Profit is an opinion, but cash is a fact. After seeing how it all connects, that should hit a little different now, shouldn't it? The income statement tells a good story. The cash flow statement, well, it tells you the truth. So, let's wrap this up. What are the big takeaways? 1. The cash flow statement is your ultimate reality check. 2. It's the best way to see if a company is truly solvent and if its profits are actually real. And 3, it's the definitive bridge that connects the story of profit to the reality of cash. So I'll just leave you with this one thought. The next time you see a flashy headline about some company's record profits, you're going to be the smartest person in the room because you won't just be impressed. You'll pause and you'll ask the real question. That's great, but show me the cash.